The first 5 trading days of any market year are important, but in 2024, could this be the biggest stat moving forward? Hello, ladies and gentlemen, and welcome back to The Daily Show, where we discuss stocks, commodities, and cryptos together. Earnings season is only a week away, and that means that we have volatility re-entering back into the market. It looks like yields are coming back up, and of course, everybody's starting to get concerned. So in 2023, was it the calm before the storm? Today, we take a look at the key levels for both the US 500, major indices, and of course, the biggest stock in the world, which is Apple. Where are the bulls and where are the bears right now? That along with our thoughts on the Mag 7 moving forward and the biggest stats that might blow your mind. Coming up in today's show. Well, welcome back, everybody, to The Daily Show. My name's Tom, and we're discussing a lot of macro and lead indicators today, including some data that might blow your mind. Remember to subscribe and smash that like button if you enjoy anything to do with markets like we do all here. Let's talk rotation because, of course, it was a session where we saw further selling in the big tech stocks and, of course, energy across the board ahead of the jobs numbers. And these will matter, and they'll certainly move things such as the US dollar moving forward, and also possibly a couple of other lead indicators. Fear and greed index went from extreme greed back into greed, and we saw rotation continue to hold up in the defensive markets. This basically means that Wall Street is still holding that defensive position that we saw them start to accumulate back in the late 2023 period. Staples, utilities, and healthcare have been the best rotations over the last 5 trading days. Just a reminder, 2024 is now upon us, and we'll be releasing our first weekly newsletter for the year next week. So make sure to sign up down below. It's completely free, and the feedback's been amazing. So thank you so much for signing up in the late end of 2023 when we launched it. Let's talk now about what the Fed is doing. So, of course, the market is predicting rate cuts. They predicted 7, now it's moving back to 6. And, of course, there are a lot of switches going on underneath the hood. But what will matter here is non-farm payrolls. And remember, it tends to be a buy the rumor and then sell the fact when it comes to rate cuts and what the Fed's doing. Never forget in 2024 that the Federal Reserve is not rate cutting out of the goodness of their heart. And they tend to do so because there is weakness in the economy. They usually push the economy too far, something breaks, and then they start to cut. So remember, rate cuts are not actually good news when it comes to eventuality and when it actually comes through. And we've got stats coming up on that in subsequent shows throughout 2024. So here's one of the big ones. Now, you're probably sick of hearing about Santa rallies and this and that. There are a couple of different Santa rally stats that you can use. There are ones to do with the Grinch, which we've already talked about. There are ones before Christmas, the 5 days before. And then there is the one that often people use, which is after Christmas into the first trading days of the new year. Now, if the Santa Claus rally turns out to be negative during these periods, it actually has a pretty bad ramification to the markets. And you'll notice that only 66.7% of the time are markets bullish over the calendar year. And more importantly, take a look at the January number. Only 40% up. Now, if you know anything about your stats and markets, you would know that generally markets are heavily geared into the bullish or positive side. So to have a negative stat for January and a pretty bad Q1 could show you that this price action might have more to move if we break through some of these key levels during the jobs numbers. Another one to watch is 5 days. Of course, we haven't had that yet, but we will be reporting on what happens next for the rest of 2024 due to the first 5-day stat. Remember, if it is negative, that usually bodes pretty poorly, and we can start to stack quite a lot of stats together to break it all down. Some other ones that you might want to be looking at are these. Of course, if we have a negative first day in terms of the markets, what happens over the next 2 to 6 days? Well, as it turns out, Wayne's done some great data stats here, and it turns out that we usually get a positive correlation. In fact, we've never seen a negative correlation over those first 6 days. So from day 2, which we're now in day 3 of the market, to day 6, we tend to have an 8-0 run. What do you think? Do you think markets will be able to hold this level and remain bullish with that BTFD style attitude that the market has at the moment? Well, stats would say that it is likely that markets may try to hold. Of course, look at price action first, and we'll talk about some of the key levels for the S&P 500 coming up later, which I think you're going to enjoy. We also have another big stat that we'll be looking at for January. And of course, we'll be blending all of these together with our thoughts and breadth and everything else that's going on so far. And that is the November stat all the way through to January 19th. When we get this later on, I'm sure it will help us to build a picture for the rest of the year. So what about the sentiment surveys? What's everybody coming in at? Well, surprisingly, and remember these sentiment surveys are taken earlier in the week, so they won't include some of this negative market tinge that we've seen to it. People were coming in less bearish. Now, that's always a concern. When you have huge bull levels, such as we've had for the last 4 weeks, and then you drop the bears again, it means that markets do have room to move. Everybody became pretty complacent. You can kind of see it here. And during a period of low, let's say usually low volume, we saw big trades come in. And of course, they've smashed the market around. Some positive signs, though, for markets, of course, things like the McClellan Summation Index here have shown that markets may have more room to run on them. We don't have too many reads on this one, but over 60 years, over the next 6 to 12 months, we tend to be bullish. So remember, pullbacks here, while they might be sharp, they might be vicious, and possibly they might even last for a little period of time here, they do tend to have still positive correlations. So we do have to give some credence to the fact that breadth improved during this market rally, and therefore pullbacks should be met, you would think, by bullish demand. Here's a really interesting chart that has the VIX of Apple versus, of course, the VIX in general. And you'll notice that volatility has spiked hugely in Apple while not spiking in the market anywhere near as much. Now, we've seen other times where Apple has led in terms of seeing this volatility, and it hasn't necessarily led into market VIX. You can see here that different markets are going to react differently. But I think since the advent of zero DTEs, we have to look at it a little bit differently. Remember, Apple is still the canary in terms of markets, and it can show us a lot about how healthy the market really is, because in many ways it shows the world's consumer, and that's something we will be looking at. We do have another chart that we can watch on the markets for the American consumer anyway, coming up later on in today's show. Let's now talk about dumb money confidence. We all know that we're retail traders, and often we get a little bit too happy when things look really, really good, and that can be a mistake. Well, of course, when we get dumb money this high, here are some of the stats. We shared this in our previous video, and it shows you that January, again, is leading into possibly being a bit of a negative month. 1 month later after this read, which we got late on in 2023, you only have 17% of the time markets up. The problem is we don't have too many stat data points for it, but something to keep in mind if we do break through that key 4,700 level, which we'll look at later on today's chart. Dumb money confidence also being this high tends to lead into 3-month pullbacks, and that would take us through that Q1 period, which we already saw had some poor stats with it. Again, price action will lead the way in this case. So what happens if 4,700 gets taken out during non-farm payrolls? Well, according to the options market, there's a good chance that we could move towards the 4,600 level. That seems to be the next big gravitational force, and 4,700 has been holding markets. Remember, markets went negative gamma, and I posted this over on our X account as well. And what it tells us is that we took out all that positive gamma that was leading us up in literally only a few trade days. There's a lot of options expired, and it leads to a positive, basically a decent possibility that CTAs and other markets are actually starting to sell a little bit into this. What about the Russell 2000? We've been talking a lot about the positive correlation from the end of the year into the start of the year. And usually it's this kind of first couple of trading days that can be a problem as people take profit for taxation reasons and all sorts of other reasons out there in the markets. Then we tend to lead into a lot more positivity. Remember, what happens really from this point to the next kind of week is going to be very important on whether the Russell is going to hold true for the rest of January into February like it usually does. We do know that most economists are wrong, and generally they are wrong big time. But for 2024, they are basically marking that the market won't go up very much more. And they saw basically a 1% upside, so call it like a 3% upside at this point in terms of their overall calls. Do remember, these economist calls are usually completely wrong, so it's better off to not stick with them. But something you could keep in mind that at this stage, unless Q1 earnings come out very positive, it's not like they're going to be saying, wow, it's a great time to buy in markets. Speaking of which, CTAs, positioning has started to move negative. And as we saw in the last video when I posted, Goldman Sachs is telling us that in their metrics, there were pretty much just overbought stats from the CTA estimates. It was either flat, down a little bit, or down a lot in terms of what CTAs were going to do next. They were kind of overbought. So profit taking into the calendar year makes a lot of sense. They take some profit, they make some money, they get some performance bonuses, and then they dump off a little bit here. Well, it seems like that's at least what the metrics are telling us, and it could be a reason why we're selling off at this stage. Let's also talk about spot gamma exposure. You can see here that we went from positive gamma down to negative gamma straight away. We went neutral, then went negative over the last 2 trading days. And it's just showing you again that the market could be gravitating towards those lower strikes. 4,700, very important strike. 4,600, the next one if we break down. What about the NASDAQ? Some more positive signs here. The breadth, of course, momentum, very important. Now, when we've had similar reads to this from the NASDAQ in this case, we've tended to actually lean into very bullish periods for markets. So again, that person that's looking for that longer period, that's 6 to 12 months, should they be terrified right now? A lot of the internal momentum stats and breadth say no, you probably shouldn't be. Now, across a trader and somebody that's looking at shorter periods of time will be looking at opportunities moving forward. But a lot of these are still reading true, which is basically that we could go sideways, even down a little bit here due to everyone being a little bit too much bullishness. But overall, the internal momentum is still looking quite positive. Do you agree with this statement? Do you disagree? Let us know in the comments down below. Let's now talk some large traders. So did we see any big traders come in? First up, S&P 500 3x leverage SPXL fund, a big trade coming through, which is kind of putting a base in the S&P. And this will become important when we look at the chart together a little bit later on. We've also got our AAPL chart that we spoke about, probably some form of distribution and take profit. Where do the larger traders enter? Well, you can see down here, there are quite a lot of trades, and we'll be talking about that most accumulated zone a little bit later on when we look at Apple. But yes, this was kind of a warning sign. It took a long time for Apple to turn over. And at this point, it looks like it's kind of going towards that key accumulation zone we'll speak about later on. Another one is treasuries. Did we move up too quickly? Yields, of course, dropped like a rock. They hit some key levels we've spoken about on the channel. We've seen them bounce up. And depending on what happens with the non-farm payrolls number, we might see yields go up more and treasuries come down. Remember, somebody most likely sold into these announcements. It doesn't mean that treasuries are done, it's the end of treasuries or anything, but it does explain why markets are coming down off this point, and we've spoken about this quite a lot. Kind of looks like a small time Wyckoff distribution on the charts. Let's go over to unusual options volumes. Now, it wasn't a huge day of options volumes. We don't expect that to kick in usually till the middle of the month. 34 mil over 39, 56% call. So still a lot of people trying to buy the dip, and some big activity here in things like treasuries and bonds in general. And then we saw some other activity coming through some of the major stocks. Nothing really notable here, though. A pretty even spread between the number of puts and calls through most of the major key markets. Let's jump on over to equities and, of course, start talking about lead indicators to get off with here. And it's got to do with central banks. So central banks, as we saw, dumped a lot of their kind of tools coming into the end of the year, which we've already talked about as being a fairly normal thing that happens due to the closing of accounts, etc. It's what happens now, though, that's going to be important. So you can see here there's a bit of an uptick. If we see price actioning coming down and then markets such as these central bank liquidity indicators are coming down with it, again, it's a cause of concern. If we see these start to pile back in and keep moving back up, though, it's going to give you a lot of credence to say that key levels such as this demand down here could hold markets, or even where we are right now. And there are some key levels that we'll be looking at for breaks. Let's take a look at the US 10-year. What's going on here? Well, we had our set alert level, and obviously from that point, we've seen some bullishness come back into yields. And you can see here it's come back to the 20 moving average. Now, notice ahead of non-farm payrolls, we still are not able to get above these wicks. So clearly this is a key zone. 1, 2, 3, 4. So we have many, many touches to the 20 moving average. And if we breach above, then we're probably going to move towards the next level, being around that 4.2%. So that would be yields up, treasuries down, etc. Another thing that could be leading into that 4.2% call is mean reversion. And that's when we see the market go back to the 20 moving average on the weekly. And you can see that mean reversion is quite common when it comes to markets. They come back down or they come up to these 20 moving averages and they often hit them. And these are key levels. And of course, the 20 is my favorite moving average easily on the charts. And you can kind of see why when you go back over and have a look at it. No matter what you think, while it's not a trading strategy in itself, it is an incredibly good level to be building confluence and, of course, then to have your patience to react, don't predict on those zones. What an important level, 20 moving average, well worth having on your charts. Speaking of the 20, we're back down to it on treasuries. We already talked about the island reversal that happened up here and how that's leading into shorts. And I could still see the market coming down to like a 94 level, and that would be equivalent to around a 4.2% on the US 10-year. And of course, the equivalents on other yields across the board. At this stage, we do know that this was a critical zone for treasuries, and it makes sense. Why wouldn't they be taking some profit? This is an incredible gain. You know, to be going bullish on treasuries to make 21%, let alone some of the income generated on this asset as well, is very, very good. And of course, we can see here previous supports becoming resistance, the supply that led on to that final crash. But overall, I would say that the market is still looking positive towards treasuries, and I am bullish on it for 2024. But I wouldn't mind a pullback. You can see these two rejections are showing that maybe there's a little bit more to come. These are all worrying signs for the markets right now, and some things that we've been taking into account along with some of our other lead indicators. Speaking of which, we had a bad day for home builders over the last two sessions, and that's of course leading into concerns about whether this market ran a little bit too quickly and it needs that pullback. I think everyone's going to say, well, yeah, it did run too quickly, Tom. Of course it's got to pull back. But notice where some of the zones are. You've got those previous resistances, and of course you also have a weekly 20 moving average sitting on it. So if we do end up selling off further, where could we go to? You know, it makes sense to come down here. Another one that broke through and probably led for that next sell from our previous video was Dow Jones Transportation Average. That also weakened off, giving us credence to the idea of a double top. Now, if we take a double top, what are you usually doing? You take the distance between the top and the high, and then, of course, you extrapolate that out. And what that does, it gives you about 15,200. So again, another indicator that's currently suggesting that maybe markets have a little bit more to come down on. Of course, it brings us to that 4,600 idea on the S&P 500, especially if markets go through the 4,700 during the non-farm payrolls. I mentioned this before, which is our indication of the American consumer, and you need to type in XLY/XLP to get this on your charts, not what I just did then. And what this will do is it'll show you the American consumer. Basically, we've got discretionary versus staples, and that's been dropping in subsequent days. So you can see here that for 3 weeks now, we've seen drop-offs on this market, and it's showing you that people are starting to get a little bit of concerns about the market. Are we worried yet? No. Why? Well, it's not underneath 220, is it, in terms of a ratio? So still fairly bullish. This is probably just more of a pullback at this stage. And of course, we're looking at the key levels and structural formation on the S&P, which is going to be the big one. What about Dr. Copper? Dr. Copper's still sick, and it doesn't want to break our key levels. Still got an alert just below 4 at 3.95. Still looking for a breakout above this zone and a close. And if that happens, then it should be much better for the markets. But at this stage, Dr. Copper is weakening. And you can see here that it has that shooting star candle and it's stuck in the range. It's basically at the support level. So if you were to go break down smaller timeframes, you can make an argument this is where the bulls are. But I don't think there's a trade here on copper just yet. We're looking for that breakout to the upside. Let's move over to what probably a lot of people are discussing right now, which is the US dollar. And rightfully so. If the dollar manages to get above this little box here, there's a good chance we're moving into that almost 104 territory. So quite a large move up for the dollar. You can see here I've got this line plus a little red box with an area I think it would move to next. And we had our most important line, which almost marked the low of the dollar. So at this stage, the dollar's been pretty strong. Of course, a lot will happen around jobs numbers, but you'll notice here that we have some inefficiency to the market, a massive gap down over the futures contract roll, and we have this big sell that pretty much doesn't have much volume in it. So there's a good chance that if we breach this level, we're probably moving towards this zone here. And the way we do that, could look like this, could look like a lot of different things. But one of the ways that we'll be watching is if the markets kind of go bullish, bearish, and then they start rallying back up, that'll be a good sign that we're moving towards 104. And I think around there is probably where the bears sit at this stage. And this is a very interesting zone. Bears could sit here, but how does it react to the non-farms? Remember, often with non-farm payrolls, the first move is the wrong move. So therefore, it is a patience, react, don't predict. You've got to have your chess game on with this particular number. It's hard for the market to interpret, and also it's hard for you to interpret. Is bad news good news? Is good news bad news? Who knows? Bad news has been good news for a while now because it's meant, oh, we're going to get rate cuts. But the market may have started to switch its idea. Maybe bad news is bad news finally. We'll find out. I know that's confusing, but that's the problem with interpreting the market data. Instead, what I like to do, and many of you out there like to do, is we read the price action, we figure out where the liquidity is, and then, of course, we have the patience to react to those kind of conditions. Now, what about gold? Well, gold traded off its most traded zone. No surprise, really, it would try to do something like that. This is the critical level for gold bulls, and they'll be trying to hold it above this area. For bears, congrats. I guess that would be an excellent take profit zone on your shorts that would have been entered around this area in here. And yeah, it looks, I guess you would say, neutral at this point for gold. You can see here the daily, how it looks. You've got some rejection weeks. You've got the 20 moving average. It's holding a doji just above that. So I would say pretty neutral on gold. Not much opinion on it leading into the event. Oil, on the other hand, this was one that we had that little red box for the short, which is around 74. We end up seeing the short come down. It hit into our critical box down the low here. It rallied back up and then it got close to 74 and then we saw some selling. Another one that's going to be tough to read because we've got the long leg doji. We've got that indecision ahead of the big news report. There are some bulls that would really like the market down here and they'll be looking for that bullish breakout to see further strengths, because of the instability in the world right now, leading into oil kind of picking back up. But the bears, if you get underneath 70 and close below, I would say a new low is coming for oil. So, close below 70 is going to be a big deal on the daily. And I think the reaction after non-farms could be the most important here. Let's move over to Tesla. So this is the first stock, and it kind of points towards a little bit of negativity still going into this market. Where's the big trade zone? Well, we already know that there were tons of buyers all the way through this level here for Tesla. So that's around that 233, 234 zone. We're currently trading at 238. So this will be an important level for the bulls to hold up. If they lose this zone, then we could go really low for Tesla. So Tesla coming into one of the most important levels that we've seen in some time. We obviously got that kind of like false daily breakout up here. And then we ended up rejecting that with that nasty looking weekly candle, which has led on to some good trades this week if you were able to short below this zone. So down into here seems like where I could see some sellers kind of remove positions. And I think a lot of this will all be about non-farm payrolls. You can see that we're kind of trapped between a heavily traded zone and a heavily traded zone. So both of these levels are very, very key. If we move over to AAPL, it's pretty much a similar story. There's a little bit more room to run down before we get into a very heavily bought previously zone. We can assume it's purchased because the market ended up rallying up. We're not near the bear zone yet in terms of the most important area. For shorters, they're going to be looking at this a lot of the time for take profit targets or zones that they will be interested in potentially reducing their positions. And it's going to be a very important level. So I would say that this will be a zone to watch over the next 24 hours in particular for the biggest stock in the world. German market fell back down to the highs here, just underneath the 20 moving average on the daily, so that mean reversion kind of area. Hard read here on the German market still. You might say, well, Tom, it's clearly short because we had a rejection, another rejection, this is a liquidity grab, and now the markets are lower. I just don't really see an easy trade from this point, so we'll probably leave the German market for now. Aussie market's still weak at the highs. We've got an alert above. If we do get an alert above, we're probably going towards 7,800 for the breakout, I would say, to 8,000. At this stage, it's in the hands of the US market. So the US market's dictating a lot of what's going to happen to the Aussie market as well. And you can see here that we have a lot of shorting off this zone. So for now, that's where the weakness is. And non-farms will clean that up. US 2K, so the Russell. What's going on with the Russell? Well, the Russell's come back to that 20 moving average. And you can see it's generally held around that zone. So you might say, well, it's underneath. Sure, it's technically just a break underneath. Depends which 20 you're using. And you can see here we've got a doji. So what's that telling us? Well, I wouldn't say it's completely broken underneath because we have that doji leading into non-farm payrolls. It's basically saying we're at a really important zone just ahead of the biggest news. So, of course, that makes sense. We will find out the way it wants to trade. The S&P will be the guide here. Now, some negative signs, of course, we did get underneath some of the critical levels. So we've spoken about this a little bit. We've talked about these little zones underneath here and how this is where the last bulls will really sit before 1860. So remember, if we go down lower, where do we go? Most likely 1860-ish zone for the Russell 2000, but the S&P will most likely lead the way here. So let's look NASDAQ first, and then we'll go S&P. NASDAQ quite weak, through the 20 for sure, closed below. It's trying to say to us, I guess in many ways, that we might be going towards a much worse number. 15,800 comes to mind straight away on the NASDAQ, and it could lead down there. It's basically quite a bad looking candle as it states right now. We've got those highs. We obviously went to a new all-time high, sucked in some buyers, no doubt, up here, and then we've rejected off that level. So for buyers trying to get in to buy the dip, is this really the best zone? I would say it's not really an easy one to pick. The S&P is probably the best read though, because you can see here, this daily candle is horrible. What it did was it went up a little bit and then it rejected straight back down, not breaking through key levels we'll talk about later on. So the 4,700 zone, this area here, very important. 4688 on the real market, of course, 4,700 on the futures right now. This looks pretty negative coming into the jobs numbers. It's starting to open up that idea of 4560 being the next pullback. And we do have some signs of a swing turn. Now, I'm going to go into the actual futures now to show you what we're looking at. So here's the watch reaction here zone, of course, just underneath 4,700. We know this is a key point. If we go to the 2 hour, you're not going to get much information from it, but let's go 15-minute chart. And what we're doing here is we're having a look at the way it traded. So in the previous video, we talked about how we wanted this market to get above these previous highs because it was making a series of lower lows and lower highs. We still haven't seen that. So we're still seeing a market that it rallied up for shorters. If you got into that, well done. Good work for you because, of course, that was a pretty good little zone for shorters to come in. You could have put stops above there, etc. However, at this point, to be a buyer, we really want to see commitment above 47.30. And do we have that right now? The answer is no. So for now, the market's actually in a small time short, and it's in a short to the downside. It's in arguably a swing turn level as well for non-farm payrolls. So you can see what's at stake here over the next 24 hours and into earnings season. And it could be that by the time we get into earnings season, we're moving quite a lot lower. Maybe we actually do make it back down into that 4,600 to even 4,550 zone before or during earnings season. This is a real possibility now in the market. So very important bull buy level. We want to see some strength. We haven't seen it. You can see that rejection wick off the daily. So it's suggesting that further shorting could be here. And until we get into this zone, I don't think we're really at a point that's going to interest a lot of these kind of buy the dip CTAs and all of those types of bigger players. It's not really a substantial enough pullback. We did see some trades come through, or I guess Apple got a couple of trades into it, but you can kind of see how this is correlating a little bit with some of those accumulation zones on things like maybe a Tesla or an Apple or many other stocks. So yeah, very, very, very important zone. I think it's going to be a patience, react, don't predict. Key levels on both sides. Another one that you might have got a little bit excited about shorting was Bitcoin. Did we make it underneath 40K? No. Have we changed trend? No. So at this point, still melting up, still moving higher, and still possible reactions around that 47 to 48K. So some key zones moving forward. Again, levels we'll be watching on the markets. And the 20 moving average, this thing has held like a beast. Have a look here. Look at this zone, 20 moving average on this daily, still holding this market and making sure that Bitcoin doesn't want to move any lower. I guess another notable thing that we want to mention here on the S&P 500 was the weekly 20, the mean reversion. It will end up colliding with around that 4560 to 4600 zone if we do end up shorting down, which will give us that mean reversion pullback that we often do look for in good rallies that are going to sustain, because of course a vertical cliff like it has been is not very good. So this is something we'll be looking for, because you can see here, even in 2000 and let's call it 20 to 21 rally. When we broke through that 20 and we stopped that bear market, we pulled back to mean reversion many times. And it was often one of the better pullback zones to be watching. So there's a lot moving forward, a lot of reactions to be had. Watch all these markets, even Ethereum here on the crypto side, 2 massive weekly long leg dojis, tons of indecision and confusion out there in the markets. Sometimes it's better to be out of the market. That is a trade in itself if you're confused and you don't know what's going on. But there will be some good trades, I'm sure, over the next 24 hours. Let's move over to why this is a big number, and it's because it's non-farm employment change. Remember, it comes out 1 hour before the market opens, and their expectation is 168K jobs added. Do I know what the number is going to be? No. Do you? No. But what we do know is that it is a volatile time, and often the first move can be false. So you can be very careful with that. And of course, one of the best realities of trading non-farms is to have that patience to react to the market doing what you already had in a plan when it looks like it's trapping other retail traders like us. Let's move over now to the final thing, which is just to remind everybody, if you enjoyed today's video, remember to subscribe and smash that like button. And a reminder as well, first weekly newsletter coming out next week. Sign up, links and in the pinned description down below. Thanks so much, everybody. We'll see you in the next one, and good luck out there. It's going to be an interesting first 5 trade days. And will we get a red 2024? What do you think? Let us know in the comments. Bye for now.